Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Algonquin Power stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Algonquin was founded in 1988. It is a Canadian renewable energy and regulatory utility company. It actively invests in hydroelectric, wind, and solar power facilities, as well as utility businesses. It has two operating subsidiaries, Liberty Power and Liberty Utilities. We're going to look at the ticker that trades in the United States, but the company also trades on Toronto Stock Exchange. AQN is a ticker in the United States and in Canada. Let's get started with the model. This is a large cap company. 10 billion market cap. They're trading at $16.81 a share, and they have 597 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company had negative free cash flow in 2017, but positive in 2018 and 19. Net income is the profit and loss for the business. It's revenue minus expenses. And they have positive and growing net income each year. Revenue is the sales for the company. It's around 1.6 billion each year. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. Then the difference is their gross profit. That was 1.2 billion in 2019. They had a similar gross profit in 2018 and 2017. Operating expenses were a little higher in 2019, but their operating income was fairly similar to prior years. They paid about $181 million of interest on their debt. Then there's other income and expenses. And the reason their net income was so high in 2019 relative to 2018 was the other income and expenses. The company had $368 million of other income in 2019. But they had negative $141 million in 2018. Other income and expenses are not part of your core operations. For example, if you purchased a building and then years later you sold that building and made a profit, you would pass through that profit as a gain on your income statement in other. The bottom of the income statement is their net income. That was $500 million, but it was positive in prior years, so everything looks pretty good so far. This is the statement of cash flows. And this second line is operating cash flow. That's how much cash the company generated from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Utility companies tend to have high CapEx. So their free cash flow is operating cash flow minus CapEx. So they had a little free cash flow in 2019, 64 million in 2018, but they did have a negative in 2017. It seems like the company is issuing a similar amount of debt as it's paying off, because it issued $2 billion in 2017 and paid off $2.5 billion. Then the next year it issued $400 million more than it paid off. In 2019 they did issue $600 million more than it paid off. Let's look at the capital structure. They have $4.4 billion of equity and $4 billion of debt. 53% of the capital structure is equity and 47% is debt. And their WACC is 4.25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $13.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 597 million shares. And we get a calculated stock price of $20. They're trading at $17, so they're trading at a 17% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $28, so they're saying the stock is even more undervalued. My future free cash flow estimates were higher than what their actual free cash flow was. This is based off of the company's projections and analyst projections of their future cash flows. So the past 5 years, the stock has pretty much only gone up. It looks like it took a dip probably in March when the market crashed, but the stock price has come back up almost to its all-time high. The company pays a 3.6% dividend yield, and its payout ratio is 69%. So payout ratio is annual dividend payment over net income. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have $47,000 today. If you did not reinvest the dividends, you would have about $41,000 today. If you invested $10,000 in January 2011, it looks like you could have sold at any point and you would have made a profit. And the longer you held, the more money you would have made. So the company has provided their shareholders with a great return on investment. And they have a really low beta, 0.26. The stock has gone up 13% in the past 52 weeks, which is a little worse than the S&P 500. And the low was $14, the high was $22. The stock is trading above its 200-day moving average, but below its 50-day moving average. About 1.5 million shares are traded each day for this stock, and almost all the shares outstanding are on float. And about half the shares are held by institutions and has a really low short percentage. Less than 2% of the shares are shorted. And their biggest shareholder is BMO at 6.7%, then RBC, Vanguard, TD, and GQG. Let's look at their financial ratios. The average PE is 12.2, the median is 14.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 19.2, so they're worse than the median and average. That means investors are paying $19.20 for $1 of earnings. Price to sales is stock price over sales per share, that's 6.2. They're between the median and average. Price to book is stock price over book value per share, they're at 2.3, so they're better than the median and average. And the way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and that's $4.4 billion. Their tangible equity is $2.6 billion. Interest coverage ratio is EBIT over interest expense. They're at 2.0, so they can cover their interest payments 2 times. ROE is net income over equity. They're at 12%, a little better than the median. Current ratio is current assets over current liabilities. They're at 0.6, so they can only cover 60% of their current liabilities with their current assets. And their current assets are $63 million of cash, $259 million of receivables, and $91 million of inventory. So it does appear the company will need to take on more debt to run their business over the next 12 months, because they did not generate much free cash flow, and they have negative $359 million in working capital, plus their annual dividend payment is over $360 million. The best way to look at ratios to compare them to similar companies, I've done videos on Brookfield Renewable, Interchex, Northland Power, and TransAlta, all in the same industry as Algonquin. And if Algonquin has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're pretty much better in every category except current ratio. They're at 0.6. So this could be a timing thing. It is possible if I look at next quarter or the following quarter's financials, the current ratio is above 1. So to summarize, I have them trading at a 17% discount. Their ratios look really good. Their financials are okay. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.